In the US, it's still, the leadership is still with technology and healthcare, and I don't think you can move away from that until we see a break in the psychology. And within healthcare, again, as I mentioned in technology, so in healthcare, there are major stocks, particularly in biotech, that are trading on quite reasonable multiples. So you look at Amgen, you look at Celgene, you look at Biogen, IDEC, and so on and so forth. These are big established companies, and the valuations are not extreme. So that's one place that I would look, in addition to the tech in the US. Japan is a lot more difficult. As ever, Japan marches to the beat of its own drum to some extent. Some of our fund managers are taking on the banks there as an investment. These banks obviously have had a torrid time in the last 20 years, but our analysts feel that the balance sheets are in better shape. Property prices and property rents in Tokyo are stronger, and that should underpin the banking story. So that's an area for Japan.
How about Europe? You mentioned banks, Japanese banks. Let's focus on European banks. We are about to find out what the ECB or the stress tests of the ECB are going to tell us about the banking sector. Is it a good time to bet on some of the major ones that seem to be fine because of the correction that essentially has been somehow forced by the fear of the results of aforementioned?
The stress test is a very important policy watershed for banks, if it's done properly. Because I think that the banks, the European banks, could use the stress test, and the ECB could use the stress test, to have a genuine look at who can repay debts that they've taken on and who can't, and have a genuine markdown of those who can't pay. That could happen, and if it did happen, I think it would be very beneficial for the economy as a whole, as overburdened previous borrowers, previous careless borrowers, were relieved of their debts. Is that fair? Well, I draw your attention to the fact that when a loan goes sour, two mistakes have been made. A borrower has made a mistake in borrowing too much, and a lender has made a mistake in lending too much. And for a genuine stress test to bite, the lenders who have lent too much must admit their mistakes. Do I think it will happen in sufficient size to make a difference? Regrettably, no.
So no consolidation of the European financial industry?
There may be consolidation, but I don't think that we will get to the stage where the lenders who have lent carelessly in the great financial crisis recognize those mistakes and relieve the burdens on some of the pressed consumers. And if that doesn't happen, then demand doesn't recover in Europe.
Okay, so that's banks, or more generally financial industry sector?
I think particularly the banks. Particularly the banks, because the insurers weren't really involved in the overextension of the great financial crisis this time. They were involved in 2000, 2001 in some questionable investment practice, but they're pretty clean this time.
Let's look at Europe and what is interesting at the moment then. Which sectors do you like?
It's fairly obviously the exporters, with the euro doing what it's doing. The big consumer companies that are linked to emerging market stories are starting to perform better after a weak patch. They'll probably get another boost from the fall of the euro. So I wouldn't look any further than some of those big multinational consumer non-durable companies. Maybe the luxury companies, as the bad news from China annualizes through. Maybe even the autos. I don't know. That's a bit more speculative. That's a bit more cyclical. For me, I would still stay away from the financials. Now, the financials have done very well in the last 2 years, but I would still stay away.